Hi, this is Michael Fisher for SavingAndInvesting.com, and I want to talk very briefly about the importance of bearing in mind the key principles when it comes to saving and investing. Now, there are a number of key, very fundamental concepts that have been the primary focus of everything that's related to the Saving and Investing videos and SavingAndInvesting.com premise. And those are concepts such as compounding, the time value of money, diversification, dollar cost averaging, there being a reason for products to exist, the interaction between providers and users of capital, thinking about investments in terms of how they might work and why they should work, and what the actual underlying mechanics of the provision of capital is by the investor, what the basic contract is that's being entered into. Are we owning equity? I.e., are we becoming an owner in a business as a shareholder, as a private equity holder, or are we a lender, either a lender directly through a contract or through a bond, and what the overall structure is of that interaction between the investor as a provider of capital and the user of capital, and how the capital markets play a role. And all of these considerations have to be borne in mind first and foremost when we think about 401k plans, when we think about index funds or mutual funds, or when we think about the time horizon over which we should invest, when we think about dollar cost averaging, when we think about making contributions to a pension plan and how we make them, i.e. potentially small amounts over a long period of time, equal amounts to take advantage of the benefits of dollar cost averaging. The concept of diversification and trying to bring together uncorrelated assets or low correlated assets that all have a very good expectation of going up over the long term, but that over the near term will not necessarily move up or down together, so that we don't end up seeing all of our investments go down at the same point in time, and there's some dampening of that effect and some benefits from having assets that move, that have lower volatility and similar returns through diversification. All of these concepts, including of course providers and users of capital, have to be really borne in mind whenever we think about any investments as first and foremost considerations, because otherwise we're looking at the outside and the shell of an investment as opposed to really getting into the meat and the bones of it and the nitty-gritty of why that investment might work. And if we don't have a clear view as to why this investment should work based on some of those concepts, then probably we should be very, very careful about considering it as an investment in the first place.